Hello and welcome once again to News Unlocked, the show that takes you beyond the headlines, beyond the noise, to focus on the real issues of the day. Today we take a dive into one of the major issues that will confront the country in the weeks and months ahead. As in COVID times, India's economy gets stressed. The banking sector in particular is deeply in trouble. India's credit flow, the threat of rising NPAs is rising. And there are also, of course, fears that people inundated with bad loans may, in a way, once again trigger a banking crisis. These are some of the issues that we will raise, including the role of the Reserve Bank of India. We will hear from the former RBI Deputy Governor, Dr. Viral Acharya, who has just written a book on the financial stability in the country. But let's tell you what we have on the show at the moment. Take a look at the banking sector crisis.
Former RBI Deputy Governor's big claim. RBI Governor quit fighting for autonomy. Did government go slow on loan defaulters? RBI's independence under threat? COVID poses new challenges. 50% loans under moratorium. Bad loans set to skyrocket. Banks want corporate loans restructured. The return of the banking mess.
India's economy is in dire need of jumpstart. Both production and consumption have taken a hard hit. And experts point out a choked credit flow problem is not helping the situation. RBI believes that non-performing assets could rise substantially from March 2020's 8.5% to 14.7% in case of a severe stress on the economy. On 30th August 2019, Finance Minister Nirmala Sitharaman had announced amalgamation of 10 public sector banks into 4 big banks. This was all done to shore up the banking sector, along with the announcement of rupees 55,250 crore upfront capital infusion in the public sector bank.
Target is $5 trillion economy that we want to reach, a robust banking system that we want. So we are trying to build the next gen banks. The large capacity of one bank, the technology driven capacity of another, and the strong deposit franchise the third has are all being brought together. So Punjab National Bank, Oriental Bank of Commerce and United Bank will be brought together, and they shall form the second largest public sector bank with business of 17.95 lakh crores.
But despite the big moves claimed by the government, not much has changed on ground. In fact, the scenario has possibly worsened. A major source of the concern is the credit moratorium scheme in force. About 40% of the 106 lakh crore loan outstanding of banks is under a 6-month moratorium ending in August. It is feared banks will be inundated with bad loans once the moratorium ends. In light of the pandemic, there has been growing demand to extend the moratorium till at least December 2020. But some big private bankers have also advised against extending the moratorium further. Bank credit growth has already decelerated from 13.3% in financial year 2019 to 5.9% by March 2020, causing considerable strain in the system. MSMEs, which have one of the highest gross NPAs of over 15% for government-owned banks, has come under severe stress post demonetization and GST. SBI's gross NPAs in small loan segment have jumped from 12% in March 2019 to 15% in March 2020.
The biggest fear in banking right now is this possibility of an avalanche of non-performing assets when the moratorium gets over at the end of August. And what has puzzled the bankers the most is that even those who can pay EMIs have ended up availing these loan moratorium, and as a result of which about 40% of 106 lakh crore of loan outstanding is currently under moratorium. The RBI also suspects that if the economic crisis worsens, the non-performing assets of banks could be as high as 14.7%, almost 15% up from 8.5% today. And so RBI has also asked the banks to be ready with some kind of buffer capital.
According to India Today's banking sources, private banks are already preparing for a contingency. Some banks have reportedly raised major amounts towards building the much-needed buffer capital to handle higher NPAs. They believe this would allow them continued credit flow in the case of exigencies.
And joining us now to look at the banking crisis that could be once again staring the country is Dr. Viral Acharya, the former RBI Deputy Governor, who's now Professor at New York University after quitting the RBI in July last year, 6 months before his term ended. And you've just come out with a new book looking at financial stability and the need for it. The big question, Dr. Acharya, before I turn to the present banking crisis, the elephant in the room that you've raised in your book and earlier at the A.D. Shroff Memorial Lecture in October 2018, the autonomy of the Reserve Bank of India itself. Do you believe that in the Modi era, the autonomy of the Reserve Bank has been severely compromised?
Good evening, Rajdeep. What I want to stress, both as the point I was driving home in my book, Quest for Restoring Financial Stability in India, as well as the A.D. Shroff Memorial Lecture, is that for a country to grow well over long stretches, it requires very high quality institutions. And that central bank is one such institution that needs to function with operational autonomy. Now, the question is, in India, actually, if you read Dr. Y.V. Reddy's foreword to my book, he stresses that these pressures have always been there. And the key is now to understand why these pressures are increasingly becoming large, even though we have witnessed the negative consequences of these in the form of the last NPA crisis of the last decade. So the question I want to pose is, why is it that in spite of acknowledging that these pressures lead to severe banking problems, that we are unable to find as a system a way to actually get out and restore financial stability in India? So bottom line, to answer your question, I think the pressures have always been there. They seem to have gotten excessive in certain periods of time. But the key question to me is that why is it that now, even after having seen a demonstration over the last decade, that when these pressures surmount and lead to bad outcomes, we don't have the willpower and the conviction to actually stop this process from happening all over again?
You know, Dr. Acharya, let's call a spade today. One Reserve Bank of India governor didn't get an extension, Raghuram Rajan. Another quits midway, Urjit Patel. In fact, he reportedly resigned over undermining of RBI's autonomy, as your book seems to suggest. Let's call a spade a spade. Someone like you also quit early. Why? Why are so many talented central bankers quitting?
Yeah, I think that's a good point, Rajdeep. I think the point is that I don't want to make this about individuals or personalities. I also don't necessarily want to make it about just a statement about where we are. I want it to be a constructive dialogue as to what is the root cause of this pressure. The root cause of this pressure is the fact that we don't have fiscal institutions in place to restrict government expenditures, ensure that their quality is high, and to have transparency about the fiscal accounts. I think we risk that if we just keep focusing on individual outcomes, personalities, and specific episodes, we miss the bigger picture. I think the bigger question and debate we need to have is what fiscal institutions we need to put in place right now, so that we can give confidence to investors of our debt sustainability in spite of a shock such as COVID requiring us to undertake further expenditures.
You know, in a way, though while you are reiterating the importance of institutions over individuals, the fact is, as I said, in the last 6 years, we have seen quality people leave the central bank. Dr. Y.V. Reddy, former governor, says pressure has always been there, as you also claim. But why are people leaving? I'm sorry to raise this, but is there something fundamentally wrong with the way the Narendra Modi government's relationship with the Reserve Bank of India has been, where the autonomy of the Reserve Bank of India to take important decisions has been constricted?
It's a good question. Listen, it was not just about the pressures have been there in the past. That's what Dr. Reddy is also saying. You know, there's a reason why Dr. Subba book was called "Who Moved My Interest Rate." I think what we fundamentally need to understand is that India has changed as an economy over the last 3 decades. India used to be more or less a nationalized country. Financial savings were repressed. Banks were essentially told that when you get deposits, a huge chunk of that you need to buy government bonds. And all this was a very sort of happy system because the private sector was not considered as an important part of the growth engine of the country. What changed in 1991 is that we realized that there are limits to how much we can grow as a nationalized country. We need private sector to thrive. That is where quality firms, quality ideas, quality innovations would actually come about.
You know, you seem to suggest, Dr. Acharya, that the government is in a way going to some of the bad old days, that once again we are seeing that bad loans are rising at the moment. This is a point that even Dr. Urjit Patel makes in the book, that he believes there's a dilution of the insolvency and bankruptcy code, which is seen as one of the achievements of the Modi government. Does that worry you, that we could be going back to the days where NPAs, the non-performing assets, will once again balloon, more banks will be stressed, more will collapse, especially in COVID times?
Certainly RBI's recent financial stability report seems to suggest that in a stress scenario, which now a lot of economic analysts are also attaching a very high probability of, which is a GDP contraction, mainly a negative GDP growth rate, that the bank NPAs could become very large. As I have been saying, the RBI did resist the moves to have unprecedented excesses in credit and liquidity. We did not allow a repeat of what happened over the last decade. In that sense, the day was saved at some professional cost to all of us. I think the key right now is to recapitalize the Indian banking sector and the non-bank financial sector, one. And second, to put in place fiscal measures so that we are able to meet the demands to support growth when we come out of COVID. So I think there is still time for action. I think there is still time for structural reforms. In my view, it is never too late to take a step towards financial stability, fiscal stability. Those always pay off in the long run for the economy.
You know, Dr. Acharya, you seem to also say in the book that the government, which was going after defaulters for some time, in 2018 went back to, as I said, the bad old days, especially when it came to bad loans. Do you believe that the government is once again going slow on defaulters? Have there been a failure to implement the insolvency and bankruptcy code strongly enough? Have we taken a step back after taking a step forward?
Absolutely. I think it was definitely a step back. I think there were short-term pressures that the government had to try and boost the growth numbers, whichever way. They resorted to what is now emerging as like a standard practice for the governments to lean on the central banks to relax the rules, open up credit-fueled growth. And we have already seen this in the last decade. Our point was that on the one hand, we have put in place the bankruptcy code precisely to actually help the cleanup. And how can we, in the midst of that cleanup, actually encourage exactly the form of excess that we are trying to avoid in the first place? But my point in the book is that there are deeper pressures beyond actually just the bad loans. And I think I was highlighting that what is being done is that because the fisc is not in shape, because the fisc is actually overstretched, because there is no headway there to accommodate the growth pressures, then you turn to the central bank to solve your problems rather than taking the difficult actions that are needed on the fiscal front. And that pressure on the central bank is actually pervasive. it has the potential to affect its various policies. The monetary policy doesn't get affected as much because we have an institution there. We have a monetary policy committee that is given an explicit inflation targeting mandate, whose violation would actually require that the governor present a testimony to the government. So we need institutional ways to actually reduce these pressures. I want us to think a little bit beyond the headline issues of just the defaulters. Clearly, that's one of the most important issues facing the financial sector. But I think the pressures on the central bank, in my view, go beyond just that issue. I think they are more pervasive. There are attempts to use liquidity policy to affect the government bond yield curve. There is an excessive demand for central bank reserves as a coercive monetization of the government deficits. And there is lack of allowing the markets to function. Why shouldn't minority investors in the stock market know whether their company has defaulted on a bank loan? They should know it the very next day, as is required on exchanges in other parts.
I take your point, and we've seen a number of banks, of course, private banks collapsing in recent times. You seem to be, I'm looking for the headline because you as a former RBI governor are admitting that we are not doing enough at the moment to check bad loans and defaulters. We need to do much more. The institutional checks and balances are needed much more. Am I correct that therefore we are a long way from resolving the crisis of these collapsing banks?
Absolutely. And I think I lay out a range of mechanisms in the preface chapter and in the rest of the book. I'm sure Dr. Patel's book also provides some excellent guidance on how we could go about doing this. But some of it just requires allowing the foundations of financial stability that some of us were trying to put in place in 17 and 18 to be allowed to take hold in the years to come.
But what is the flaw in the system? Why do these frauds, bank frauds, where large banks are in danger of collapsing, seem to happen? Whether it is NBFCs or large banks, what is the flaw that is allowing these frauds to continue? Is there a problem in the supervisory system, or is this political pressures involved?
It's a very complex problem. I think Dr. Patel's book actually focuses a lot more intensely, I think, on this issue. My view is that it's which is not entirely different actually from Dr. Patel's. It's maybe just slightly different in emphasis. My sense is that the frauds are actually an outcome of the fact that in the end, we actually don't run a well-capitalized banking system. They are always risk averse to lend to the healthy firms. They are risk averse to take losses and take the defaulted borrowers to the bankruptcy courts or do some prepackaged bankruptcies because they have no capacity to absorb the loss from a debt write-down. Rather than recovering on the loans, resolving the distressed assets, they are primarily focused on kicking the can down the road, turning to the regulator to accommodate them in one way or the other. The second point I would like to stress is that all of this goes on because India's fiscal situation is not in great shape.
Yes.
Why are the banks always concerned about capital? Because there isn't an IV drip approach to providing capital to our banks rather than actually doing significant blood transfusion when the problem is severe. And third, this is a point I touch upon the book and doesn't get as much discussion, is that we need to disclose. Debt is a contract where if you don't make a payment, the creditor needs to know, the rating agencies need to know, the markets need to know, because they need to reprice their assessment of the prospects of a firm that is not able to generate liquidity to meet its debt payments on time. For the longest time, we have given our borrowers a big break. 30 days grace is simply too much. Default disclosure on bank loans needs to be made public the very next day so that credit rating agencies can regrade these firms. Again, why isn't it happening? Because that will increase the losses and the capital burden on our public sector banks, and we are never leaving enough capacity in the fisc to provide for that. Right. So I think we can solve each problem piecemeal, but I want to come down to the fact that fundamentally, a weakness that India is now facing is that we have not reined in our fiscal expenditures, and in a market-based economy where the private sector now has been fired up to grow, has ambition, and it is required to grow for the demographics and the poverty that we face. I think India cannot continue the fiscal path that it has been on over the last 10 years.
You know, that precisely brings me to the real concern at the moment, fiscal stability. Do you fear that as the economy degrows, as the government's large amounts of government borrowings in these COVID times, the fact that the government is under pressure to restructure corporate loans, to extend the moratoriums to businesses small and large, the NPAs will keep ballooning, banks will keep getting stressed, and we could be facing a real financial crisis even in post-COVID times?
Absolutely. I think that's a fear that everyone ought to take very seriously. I think for the first time, RBI Financial Stability Report has actually put out gross NPA ratios for the banking sector in the stress scenario, which are getting close to 15%. That's a pretty large number. So I think it's a scenario that no one can just push aside. I think, therefore, the time to act on raising capital in private banks, in our troubled NBFC sector, in the public sector banks, either through disinvestments or government funds, I think this is right now. The equity markets are buoyant. We are seeing both foreign as well as domestic flows after a short period of stress after COVID. I would say that this is a golden opportunity to actually take a first step towards dealing with the aftermath of the COVID on the bank loans.
But Dr. Acharya, when do you realistically expect that the country will be back on the growth track? Do you see what is happening at the moment to be actually a long-term crisis, not just an economy under stress because of COVID? Are there long-term crises underlying what we are seeing at the moment?
There will be long-term scars, I think, as the term goes. Why? Because what's happening, Rajdeep, is that not just in India, all over the world, the productive capacity of the economy is very rapidly shifting as a result of this shock. If things were moving towards e-commerce, they are now moving at 4 times, 5 times, 10 times that pace. If things were moving towards reducing the operating leverage in the form of physical infrastructure, that is also actually collapsing in a very, very big way. So economies that were used to the traditional industries for growth, that were used to housing sectors for growth, that were used to commercial real estate development for growth, I think they are going to have to innovate. They are going to have to readjust their productive capacity to the new sectors of the economy. Health, pharma, infra might be the areas where the newer developments actually take place. Now, these adjustments can't happen overnight, especially when borrowings in large quantities are involved. So the growth is likely to remain patchy. What is further adding some headwinds to this is that there are geopolitical tensions of various types that are brewing. They are causing havoc to the global supply chains as we speak. Whether India is a beneficiary of that, so that we are able to attract some of the supply chains to India, or whether it suffers because the cost of imports goes up. I think that really depends upon our ability to improve the ease of doing business in India. I think we need to make for the world, we need to make for India, and what we really need is a genuine ease of doing business in India to improve. That requires a very clear focus on what sort of long-term structural reforms are needed, what sort of infrastructure we need to put in place, what sort of digital infrastructure we need to have all over the country in order to support the newer industries that are likely to thrive in the post-COVID era.
One final question. I guess it's my googly question. I know you're fond of sport and cricket. If you were the RBI governor, would you have agreed with demonetization? I know you joined the RBI just after that, but would you have agreed with demonetization in November of 2016?
I wasn't in that seat. I don't know what conversations happened. I don't think it makes sense as an economic policy. I think there are better ways to digitize. There are better ways to financialize. There are other ways to go after better tax collections. It seems like a very, very potentially a very hard hammer to deal with a specific problem with lots of unintended consequences. But as I said, I wasn't in the seat. I don't know what conversations happened, so I can't really give a definitive answer.
I think you've said enough in that answer, Dr. Viral Acharya. Maybe there were better ways than demonetization to deal with the crisis of cash. Thanks very much, though, for joining me and giving us a sense of what could be an issue staring us in the face, the growing financial crisis. Viral Acharya, former Deputy Governor of the RBI. That's it on this special show on the News Unlocked. We bring you news beyond the noise. Thanks for watching. Bye for now.
Hello everyone, this is Rahul Kamal here. Hope you enjoyed this video. For the latest news and analysis, like and subscribe the India Today YouTube channel and don't forget to press the bell icon to stay updated.